Hi, and welcome to the X22 Report Spotlight. Today's guest is Peter Schiff. Peter Schiff is the chairman of Schiff Gold, CEO and chief global strategist of Euro Pacific Capital, Inc., the host of the Peter Schiff Show. Peter is one of the few forecasters who accurately predicted the 2007 housing market collapse and subsequent 2008 financial crisis. His latest best-selling book, The Real Crash, America's Coming Bankruptcy, warns that the 2008 crisis was just a prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the U.S. dollar. And I'd like to welcome Peter Schiff to the X22 Report Spotlight. Welcome.
Oh, thanks for having me on the program, and Happy New Year to you and your audience.
Yes, Happy New Year to you. Now, I wanted to start out with the Fed and what they've done. They've raised the Fed fund rate by 25 basis points. And a lot of people thought, this wasn't going to happen. And they finally did it. What effect does this have on the economy, or does it have any effect on the economy whatsoever?
Well, I think the effect is actually minimal. I think the air was already coming out of the Fed's bubble, whether they raised rates or not. And I think the data clearly shows that the U.S. is re-entering recession. I think the Fed ignored that data and raised rates anyway in the waning weeks of 2015, just to kind of prove that they could, or to try to convince the markets that the economy was strong enough to withstand the rate hike, even though it clearly isn't. And so I think that we are headed into recession, and I think the Fed is going to be reversing that rate hike relatively soon. They will be trying to blow more air into the deflating bubble in the form of 0% rates, maybe even negative rates. I think they're getting ready to do QE4, which I believe will be bigger than QE 1, 2, and 3. Of course, it won't work. It will be just as ineffective as the prior rounds. But I think the markets will ultimately figure out the game the Fed is playing, and that's when the music's going to stop.
So you think right now that the Fed is going to reverse its decision? I mean, we know the ECB, they're pushing negative rates right now. We're hearing some of the Fed chairmen talking about negative rates. I mean, why do you think all of a sudden they're going to do about face and all of a sudden, turn around
Well, the economy is going back into recession. I mean, I don't think it ever left recession. I don't think we've been measuring it properly. But even if you accept the government's numbers at face value, we've had a very, very mild and very long recovery, right? This is the weakest recovery ever, and it's one of the longest recoveries ever. And it's required the largest dose of monetary stimulus in history to produce it. Now, the Fed has already withdrawn a lot of that stimulus. They're no longer doing quantitative easing, and now they're raising rates. And what stimulus giveth, it taketh away, right? I said a long time ago, you live by QE, you die by it. And so now that the Fed is trying to remove all of the props that it erected beneath the economy and the markets, everything is starting to implode. And the problem is, the Fed's policy didn't solve any of the underlying problems that the economy had. It simply prevented those problems from being solved, and we kicked the can down the road, and now we're catching up to the can, and now we're going to find out that the problems that led to the '08 economic crisis are now bigger than they were prior to that crisis. And so now we've got a larger crisis that is about to unfold as a direct consequences of what the Fed did to delay the pain. But I still believe that they haven't learned their lesson. And when they're facing another crisis, they will prescribe the same medicine, which is cut interest rates and print money. That's all they've ever done. And so why should we be surprised if they do it again?
You're right. I mean, all the economic data that's coming out of the U.S. government and the Fed really doesn't show the economy doing well, even though they're continually telling us that it's improving. I mean, they're telling us
what
that...
evidence? The only evidence they have that it's improving is that the stock market went up. Well, it stopped going up. The market was down in 2015. And so far, the first trading day of the year, as I'm speaking to you, the Dow's down 450 points. This has got to be the worst back-to-back, last trading day of the year, first trading day of the year in the history of the stock market, point-wise. And so we're not getting off to a good start. But the economic data has been horrible. I mean, look at the data we got on the last day of the year on the Chicago PMI. I mean, the worst since 2009, a horrible number. We got more bad numbers today. ISM manufacturing, construction spending, bad numbers, weaker than expected, negative numbers. We've been getting numbers like this for most of last year. All the Fed's got to point to is that the unemployment rate is low, but who cares? That doesn't tell you where the economy is going. That tells you where it's been, because that's a lagging indicator. I think a lot of the jobs that were created in the last 2 years are going to be lost in 2016. Meanwhile, a lot of the jobs were not much to brag about anyway. They were part-time jobs. They were service sector jobs. They were low-paying jobs. And the biggest reason the unemployment rate went down is because so many people left the labor market because they knew they couldn't find a job. So it wasn't that we had a vibrant economy. The unemployment rate went down because the economy was so lousy. A lot of people, just left the labor market entirely.
I mean, they're telling us the unemployment's at 5%. They're telling us that everything is fine. How possibly can the holiday retail season do well with people not working?
Oh, well, I don't think it did well. And in fact, going into the holiday season, the inventory to sales ratio, which is, how much stuff businesses have on their shelves relative to what their customers are buying, that level was the highest since the Great Recession. And what does that mean? That means that that businesses bought too much stuff because they overestimated the ability of their customers to afford what they were stocking up on. But a lot of the GDP growth we got last year was the result of the inventory build. But obviously that was a mistake because businesses never should have accumulated those inventories, which means most of that GDP growth never should have happened. And so in 2016, companies are not only going to stop buying, but they're going to start liquidating these inventories, which means GDP could collapse. In fact, I think there's a good chance that the GDP in the fourth quarter of last year could come in below 1%, which would mean that the entire year of 2015 would have been the weakest year of GDP growth of the entire so-called recovery. And I think there's a good chance that the first quarter could come out negative, which means we're already technically in another recession. And meanwhile, the Fed just finally started to raise rates just as the recession began.
Do you see more layoffs, more store closings? Do you see this happening in 2016?
Well, absolutely. I think we're going to see a lot of layoffs because a lot of people were hired that shouldn't have been hired. Just like businesses made a mistake and bought too much inventory, they hired too many people. And of course, a lot of people they hired were part-time anyway. And so they're going to be shedding a lot of these. I do think a lot of stores are going to be closing. Certainly, too, a lot of Americans who are shopping are shopping online. And so that puts even more pressure on the brick and mortar guys. And a lot of these states and cities were dumb enough to raise the minimum wage in January of this year. And so you add higher mandated labor costs for unskilled workers, higher healthcare costs thanks to Obamacare, other insurance rates going up or utilities or different things. I mean, it's just getting harder and harder for people to stay in business anyway. So I do think we're going to see more closings. In fact, over this entire recession, we've seen more businesses shut down than start up. Which is, unheard of really in American history. And also, this is supposedly the first recovery ever where the average American is worse off at the end of the recovery than he was at the beginning. Real wages are going down. Median household net worth is going down. The home ownership rate is now the lowest in almost 50 years. I mean, if you thought this recovery was bad, wait till you get a load of the next recession.
The corporate media and the U.S. government, they keep putting out statistics about housing, how well it's doing, how new construction is up, and they tell us pending home sales have increased. This is all part of a housing recovery. But in the meantime, we see corporations laying off those people in the mortgage departments, and most of the sales are not coming from the everyday American.
No, the housing market is a disaster thanks to the government. Prices are too high. The government is not letting housing prices come down, so nobody can afford to buy. That's why all the houses are owned by hedge funds and private equity guys. That's why home ownership, I just mentioned, is at the lowest level in 50 years. People are renting. They're not buying. Why do you think so many young people, even in their 30s now, are still living in their parents' basements? Because they can't afford a house of their own. They can't afford to buy and they can't afford to rent, because they can't get a job. So the housing market is on life support. Imagine where it would be if interest rates weren't as low as they are. If you couldn't get a 30-year fixed rate mortgage for 4% with a 3.5% down payment. I mean, this is all thanks to the government. If Americans had to put down 20% to buy a house, I mean, could anybody afford to buy one? No. And in fact, most of the people who are buying houses today, you look at it's all cash because these are the hedge funds that are buying, or they're foreigners. They're the Chinese that are buying our houses because Americans don't have the money to buy houses. They barely have enough money to rent.
Do you see the same type of bubbles occurring now than what happened in 2008, prior to 2008?
Well, just bigger. Because the more air you blow into the bubble, the bigger it gets. And of course, the bigger the bubble, the worse it is when it pops. So what we've got now, thanks to the Fed, is a bigger bubble than the NASDAQ bubble of the 1990s or the real estate bubble of the 2000s. This is bigger than both of those bubbles combined. And, the Fed never learns its lesson. It interferes in the market. It manipulates interest rates artificially low. It distorts decision making and investments and savings and causes all kinds of rampant speculation and misallocations of resources. And when it all blows up and we have to deal with the consequence, instead of accepting responsibility, they blame free markets and they just do more of the same. And so this is where we are right now, on the verge of the worst economic crisis yet. Because the monetary policies under Bernanke and now Yellen were far more reckless and irresponsible than anything conjured up by the maestro Alan Greenspan.
I wanted to ask you about gold and silver. We see gold and silver continually declining in price, and a lot of people thought that gold and silver was going to, skyrocket, and it's actually going the opposite way. Why do you think this is happening?
Well, first of all, you have to put everything in perspective, right? When gold started this bull market in 1999, it was below $300 an ounce. So by the time it peaked out in 2011, 2012, around then at about 1900, right, we had a spectacular rise. We've now had a 3-year correction, 4-year correction, wherever it started from. And so now gold is, 1080, 1070, 1080, around there. And people just look at the last few years and think, oh, you see it, gold didn't skyrocket like everybody thought. Well, very few people, when gold was below 300, thought that it would be above 1,000, even in their lifetimes. Yet here we are. And I think that the reason gold has had this correction, this pullback, is because everybody has been so optimistic over the last few years about the success of the Fed's programs. Everybody believes that they've nursed the economy back to health and that everything is going to be great. When they realize they haven't nursed it back to health, they just gave it more poison, and it's about, to die from that. When they realize how much worse the economy is now, thanks to the Fed, that the Fed hasn't solved the problems but made them worse, I think gold's going to have another leg up. I think gold's going to many thousands of dollars an ounce. I mean, I've always said 5,000 as a target, and I think that's probably conservative relative to where it might go. But yeah, I was surprised by the degree to which it had a pullback. But, there's an old expression about gift horses. And I think rather than complaining about the fact that gold has gone down, people should be embracing the opportunity to buy more. Because had it gone straight up, then people would have a lot less of it than they have the opportunity of having now, given the fact that we've had this decline based on speculators who have no idea what they're doing. Right? The people that are selling gold are the same people who are buying the .com stocks. They're the same people who are buying subprime mortgages. Right? Those trades didn't work out very good, and neither is shorting gold.
Now, the IMF came out, and to me it was kind of strange because normally they tell you the economy is going to be improving, global GDP is going to be like 3%, but they came out with information about the global economy that will be slowing dramatically in 2016. And when I hear this, I hear that means it's going to be a lot worse than what they're saying. And I think they're kind of trying to lead us into what is actually coming, where the economy is falling apart. Do you see the same type of thing? I mean, why do you think the IMF came out with that type of prediction?
I don't know why the IMF does whatever they do, and I don't put too much stock into their forecast, but I do think that they are right in that the economy is weak, but I think they're wrong in anticipating what's likely to happen, because I think the Federal Reserve is going to abandon its tough talk on raising rates. I think it's going to re-embrace quantitative easing and maybe even negative interest rates. And so I think the dollar is going to turn around. I think the dollar is going to fall, maybe precipitously. And as a result, global GDP is going to be much stronger, certainly measured in dollars, than what people currently perceive. And in fact, what is really undermining a lot of the global economies is the fear of higher interest rates in the U.S. and a stronger dollar, and how that's going to impact their terms of trade, how that's going to impact their carry costs on their dollar-denominated debt, how that impacts commodity prices for some of these exporters. And so I think when you get the relief of a weaker dollar, that is going to help out a lot of other economies. It's not going to be positive for America. It's going to be painful for Americans, but it's going to be positive for a lot of other countries. And by the way, everybody's talking about the Chinese currency going down, but that's because they're, allowing markets to function. And once the U.S. dollar turns, it's a two-way street. Once the dollar starts to go back down, the Chinese currency is going way up. And the last time the dollar tanked, the Chinese currency did not go up because it was tied to the dollar. But I think they're not going to make that mistake again. And the next time the dollar goes down, it's going down for the count, because we're not going to have China to prop us up.
Back, I think it was like 2011 or so, you said that, there could be riots in the streets. We were coming out of that Great Recession well, not really coming out of it, but we were in that Great Recession of 2008. Do you think this time, when this whole system starts to fall apart, do you think it's going to be equal to 2008? Do you think it's going to be worse than 2008? Do you think people are going to be shocked from what is coming?
Well, I think it depends on, your perspective and where you are in the world and how you're invested. But I do think for the United States in general, it'll be much worse than 2008, because in 2008, the pain was, mitigated by all the bailouts and all the stimulus, right? But the consequence of that was the problems got worse, not better. And so this time around, I think we're going to have to deal with the full force. And there's going to be no way to medicate the pain away, because the government's not going to be able to bail anybody out, because the crisis, I think, is going to be in government with our currency and our debt. And so I think the way it impacts the average American is going to be much greater. I mean, certainly, if you were speculating in real estate, or you were in the stock market, 2008 was a very painful year, because stocks went down and real estate prices went down. But if you didn't have any stocks and you didn't have any real estate, it wasn't that bad for you. I mean, some people lost their jobs, but not everybody. A lot of people still had jobs, and so stocks got cheaper if you wanted to buy them, or real estate prices went down a bit if you wanted to buy a house. So it wasn't so bad. And meanwhile, the dollar got stronger. So, the price of gas went down initially. Oil prices came down initially from where they were, and, some people benefited. But I think next time around, it's going to be a collapse in the value of the dollar, which is going to hurt everybody, because I think it's going to mean that prices are going to be a lot higher for the average American. Their standard of living is going to plunge. I think we're going to have more layoffs next time around than last. And so I think for the standard of living of typical Americans, it's going to be a much bigger event than it was in 2008. I mean, maybe the stock market won't go down as much. It probably won't go down as much. But it's going to feel like it when you start, measuring what you can buy with the money in your stock portfolio, when you start to see the cost of living going up. But I don't think it will be as bad in other countries, because what made it so bad globally was the strength of the dollar. But if the dollar weakens, if people, react this time by selling the dollar instead of buying it, then I think that's going to mitigate the damage globally. And in fact, a lot of people are going to benefit from the weak dollar, because their own currencies are going to be rising. And so a lot of consumers in other countries are going to be the beneficiaries of a rising standard of living as the purchasing power of their savings and their paychecks go up.
So what will the United States look like at that point? I mean, if everything starts to fall apart, prices get higher, our way of life, I'm assuming, completely changes from what we had once before.
Well, we just don't buy as much stuff. I mean, Americans just don't, buy things. We just, and we probably don't need to buy a lot of things, because we have a lot of stuff already. We don't have to keep buying, new cell phones every time a new model comes out. I mean, the ones that were made 4 or 5 years ago, they still work. I mean, so people are going to stay with their phones. You don't have to keep buying new wardrobes. I mean, your clothes, you have enough clothes. You don't have to keep buying new ones and buy the latest fashion, just, how much you need. And I think people are going to keep driving their cars. I mean, we've had a big rush. Everybody's bought new cars in the last few years with cheap government financing. So people are going to drive their cars for 10 years or 20 years. So people are going to find ways of fixing things instead of throwing them away and buying new stuff. But it's going to be a lot more difficult. People are going to have a harder time, paying for their electric bills. And so they're not going to use as much electricity. People might not run their air conditioning or their heating as much. So people will open windows and wear sweaters and do things like that. More people will carpool. People will take in boarders. People will rent out rooms in their houses. And so it's not just your kids that are going to be living with you, but some strangers too, because people will delay making repairs. Because look, the standard of living is going to go down. And the question is, what is the government going to do? Is the government going to accept responsibility for creating this mess and help us get out of it by dismantling much of government, by cutting government spending, eliminating government programs, lowering taxes so that we can dig our way out of this government hole? But there's also a good chance, judging by the popularity of people like Bernie Sanders, that we're going to go all in on socialism. They're going to blame this all on too much capitalism and too much greed, and that we're going to have even more government, which means we'll never get out of the hole.
Basically, coming up, I'm going to ask you for a prediction.
And let me throw this point in too. I forgot. I'm afraid that another thing that the government might do as the dollar really starts to weaken and as prices really start to go up, they're going to put in price controls for things. And that means shortages. That means that there's going to be, rolling blackouts and long lines at gas stations and maybe even at supermarkets. Because if the government tries to stop prices from going up legislatively, then they just create government shortages. And then you have black markets. Then if you want to buy anything, you got to buy it illegally, right? And of course, then you get all kinds of civil unrest. All kinds of things are probably going to happen as a result of this crisis that we're headed for.
What you're describing, it sounds like a third world type of country.
Well, in parts of America, it may look that way, at least for a while. Look at some of the inner cities. Look at, it's unfortunate, the character, but this is what's happened in the nation where, everybody feels entitled to something for nothing. We've created this entitlement class with our welfare state, and there are a lot of people that think that they're owed a living and they have a right to this and a right to that. And when they don't get what they believe they're entitled to, and they're looking for someone to blame. And there has certainly been, a lot of class warfare. We've certainly, been blaming, a certain class of people for our problems, and so there'll be people taking that to the streets.
For my last question, when do you think all of this will start to occur? Do you think it will be this year? Do you think?
Well, that is always a difficult thing to know, because it literally, there's all this false confidence still in the U.S. and in our financial institutions, in the Federal Reserve, in our government, and so. This our reputation, is taking a long time to vanish. People just believe in something, and to me, they should have figured it out a long time ago, but they didn't. So I don't know. Whether or not it's going to happen in 2016 or if it's going to happen in 2017 or 2018. There's just no way to know. But I do know that we're a lot closer now than ever before. All of the things that I believe will ultimately cause this, they're all happening. I'm not surprised by the things that are happening in the economy and the lack of effectiveness of Fed policy to generate legitimate economic growth. This is all a part of my big picture forecast. But things are certainly aligning to lead you to believe that that day of reckoning is coming soon. Because, once the Fed has to reverse course on monetary policy, I think a lot of credibility will be shattered. And I think people will begin to wake up. And of course, if the Fed doesn't, if they try to keep raising rates, well, it's just going to make it worse until they eventually, reverse course.
Peter Schiff, thank you for being on the X22 Report Spotlight. I really appreciate it. How can people get in touch with you?
Yeah, certainly, of course, you mentioned at the beginning of the interview, I have a couple of companies, my brokerage firm and asset management company, Euro Pacific Capital. I would urge anybody who's in the stock markets and bond markets to contact my company so that we can look at ways to diversify or basically reallocate your assets from the domestic to select international markets, countries like Singapore, New Zealand, Switzerland, places that I think are in much better shape economically, currencies that I think will gain a lot of ground as the dollar falls, and we can help you get into these markets in ways that other firms can't. So the website there is europac.com, EUROPAC.com. Also, for physical precious metals, if you don't have gold or silver in your possession, you should have some. I sell it for delivery at schiffgold.com. And, I'm not talking about numismatics or collectibles, but bullion, and we sell it and we mark it up very low. So that's how people can work with me. Of course, a lot of content. I put out information on my YouTube channel, The Schiff Report, schiffradio.com. I do a podcast. I'll probably be doing one later today, probably several this week. That replaced the Peter Schiff Show, which I used to do a daily radio show, 2 hours a day, and just didn't have time to continue that. So now I do the podcast, and I put out a lot of information that I write on my website at europac.com. You can read my articles and commentaries there, also those on Schiff Radio. And again, my most recent book, The Real Crash, America's Coming Bankruptcy, How to Save Yourself and Your Country. I updated it a couple of years ago. Originally came out in 2012, I think, and updated in 2014. I think it's more timely now than ever. So if you haven't read that book, you should pick up a copy.
Peter, thank you for being on the Spotlight.
Hey, my pleasure.